So, welcome back to another episode of China controlling commodity prices. So, for this channel, we focus a lot about stock investing, and commodities is definitely a big part of it. So, if you're interested in knowing how to interpret some of the key events in the market, then make sure you click like, subscribe for all future videos. I think a couple episodes ago, we covered the China Production Index. So if you don't know what that is, then you want to go back and check it out. Okay, so before we get started and go through this video, which is a relatively short article, I just want to celebrate another 4 successful case study from Investing Accelerator, where Chris made 20% from TD in 10 weeks, Brad made 100% from WDC in 5 months, Ben made 89% from JP Morgan in 4 months, and Arian made 39% from Alta in 1 year and 1 month. So congratulations to you all. These are fantastic, successful exits, and I look forward to your next one. So back to commodity prices. So if you have been paying attention to the commodity market, you'll realize that after the Suez Channel blockage, there is a supply chain constraint. And in addition to COVID, some of the plants or mines have been closed down due to the pandemic. So things like lumber, copper, gold, so on and so forth, prices have been going up a lot. And China recognized that issue, and obviously China is the manufacturer of the world. Commodity prices have been going up, and China, as a centrally controlled government, want to control commodity prices. So here is what they're doing, and this is just hot off the press from Bloomberg. So if we scroll down here, then you'll find the highlighted parts that I want you to focus on. So the state-owned enterprises were ordered to control risks and limit their exposure to overseas commodity markets. And the company has been asked to report their future positions for Sasac to review. And this is kind of important because when you're looking at a lot of manufacturers or companies that need to use metals, they usually have future contracts to control the cost. And obviously, right now, the commodity prices have been going crazy. So they should be having a gain if they didn't fully hedge their position. But right now, let's say for lumber, we see a sharp decline. So I think in the near future, we should see a lot of either losses in terms of future contracts, depending on which side they're on, or gains if they have actually hedged the position. Okay, so in the second development, National Food and Strategic Reserves Administration will release state stockpiles of metal, including copper, aluminum, and zinc. Now, this is important because it is very rare for a country to reverse their stockpile. Now, you actually see this with US, with Canada, actually not so much Canada, I guess, India, China, where they stockpile commodity in case they ever need it. So even though there is markets where you can just buy commodity right off the bat, but countries usually will kind of stock up just in case some emergency happens. So if China is planning to release their stockpile, which I assume will be a ton, then commodity prices will be going down. This is the prices for LME, which is London market. And here you will find the here you will see the copper and the zinc prices going down. So I think that's what we should expect going forward. I don't think this trend is going to reverse anytime soon in the short term, and at least it should drop another 20, 30, or 40%. I think after this, we can actually pull up the chart to take a look at it to give you a better sense of what's happening. So most metal prices in Shanghai fell as the Singapore Exchange iron ore contract. Shares of metal companies in China and Hong Kong declined, while Australian metal mining sub-index posts its biggest loss in almost a month. Now, when you're reading this sentence, you'll need to think that, well, the prices have actually gone up quite a bit. So even though it is the largest loss in almost a month, when you look at the chart, you'll actually feel like you're looking at a bubble. So let me show you. Okay, so I looked at a couple of charts, and I first want to show you lumber. And I guess lumber here, you can actually see this is the closest to a bubble looking chart, where you used to have lumber random length somewhere between $300 to $500, and then it spiked up. This is actually after COVID, it spiked up to around 1700, and now it dropped to 900. So this is kind of the swing you're expecting if you are a commodity trader, for example. And right now for the metal prices, they haven't gone down significantly like lumber yet, but I think eventually there needs to be that decline, or else for a lot of products like electronics or whatnot that you see, we'll have this problem very, very soon. So let's go to copper. So here's copper futures. Just click HG1. And here you will find that there is starting to have a drop in copper prices, but it's nowhere as significant as lumber prices. So I think right now we're still in the early stage of price control. So I think this will further drop more. And the next one is zinc that we want to pull up. So this one is the Mexico market, but nevertheless, you can see zinc prices are still up. They haven't dropped yet, but I think in the future, as China reverses their stockpile or whatnot, then we should expect some sort of price decline. But for zinc prices, it didn't really increase that much when you compare it to 2018, 19, and right now we're in 21. So I think compared to other markets like lumber, I think lumber had the most increase. So if we continue on the article, then you'll see that we haven't seen the country release state reserves for years. So obviously this is a big problem in China, especially when they're expanding. And for basically all the electronics, metal is a key component of it. And that is basically it for this video. So it's relatively straightforward. And if you are trying to bet on key commodity prices to go up right now, like copper, aluminum, zinc, then this is probably a good time to either exit or not be so bullish on it, because if countries are trying to control prices, then chances are it will go down. So if you're interested in learning more about investing and how you can use this kind of knowledge when it comes to a specific stock position, how to think about specific stocks, then you want to attend the free training below. So if you look at the description, the first link, then there will be a 4-hour free training called How to Get 30% from the Market. So you can click on that, register for it, and watch the free training. So a lot of people find that to be helpful in terms of market timing, how to get in and out of the market, how to identify whether a stock is on a discount. So make sure you watch till the end. It's 4 hours, it's quite long. And if you're interested, then you can be part of Investing Accelerator.